today's part with the following interruption for a public service announcement.
Welcome to Investing in Intelligence, where we talk about artificial intelligence companies, stocks, and trading using the most advanced AI models in the world. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So far this year, the S&P is up about 16%, and only 140 stocks have outperformed the index. Here's the cool thing. We own 60 of those 140 stocks. Actually, 73% of our stocks are up more than the S&P this year. And if you do the math with the numbers I just gave, you can tell we own 82 stocks. Jim Cramer likes to encourage his viewers to own just a few stocks that they know well and follow very closely. But that doesn't always work. When I was 15 years old, my grandmother passed away and left me $30,000 in stocks in a brokerage account. When I opened the account for the first time, I saw that she had invested in just a few names, one of which was Sun Microsystems. You see, Sun had been valued around $250 a share and was the bee's knees when she bought it. And poor grandma rode that stock all the way to her grave, down to $15 a share. Luckily, her grandson was better at investing than he was at talking to girls and managed to make back all the losses by his 16th birthday. That was 20 years ago, but I still don't believe in owning just a few stocks. So even though we've given you a lot of stocks this year, let's start off this episode by giving you 4 more, all of which are profitable companies, and one of them even pays a dividend. The first stock is Celestica, ticker CLS. They make switches for AI, and I know you're thinking, how many light switches do we really need in this AI house? But it's a little more complex than that. Their fully assembled network switch systems even have their own dedicated power and custom cooling. Celestica has increased earnings for all 5 of the last 5 quarters, and 80% of analysts consider it a buy. Next stock is Solstice Advanced Materials, ticker SOLS, just spun off from Honeywell last week. They make coolants used in data centers and compounds used in chip fabs. So recent spinoffs like GE Vernova have done pretty well. This one might also have some potential. So we don't have earnings yet, but we do know it's a profitable company already. The only thing newer than this stock is Zohran Mamdani, so just understand that means it's a little bit risky, just like Zohran Mamdani. All right, the third stock is Iren, ticker symbol IREN, yet another data center player, just like all the others we've told you about recently. So this one also transitioned from crypto mining to AI. Remember in the last episode, I told you there's plenty of AI compute workload to go around. Right now, 10% of the world is using ChatGPT. I think that number will go to at least 60%, maybe 70% over the next 5 years. Lastly, we have Leidos, ticker symbol LDOS, which makes drones for the US government, including unmanned sea drones. So they kind of specialize in maritime drones. They also have their hand in AI software and services for the US government. Their PE ratio is only 18 right now, and they pay a dividend of just less than 8%. So after mentioning all those names, you must be thinking, hey, you forgot to mention any Mag 7 stocks. To be fair, we did actually pick up some Meta on this pullback that I guess ended today. Did you know that Google is at a higher multiple than Meta right now? So clearly something has changed here, because a year ago, the market thought that Google was failing at AI and that their search business will be disrupted. Now people think that Google is succeeding at AI and that their search business will be disrupted. Okay, guys, look, it doesn't matter if they're succeeding at AI. If their search business will be disrupted, it's still a very bad thing. So for earnings, apparently the Alphabet division that includes Waymo had a weaker than expected quarter, and YouTube growth was strong, of course. Neither of those 2 divisions can or will make up for declining search, though. So I don't know how or how much longer they can continue the cover-up of their declining search business by doing fanciful things like counting every Google search as a Gemini query or every Gemini query as a Google search or whatever they're doing. But in the end, it really just depends on OpenAI. As soon as OpenAI starts allowing anyone to pay for ad placement in ChatGPT, Google stock falls off a cliff. Listen to this clip from CNBC.
Really, the only threats are TikTok from ByteDance and OpenAI on the consumer side. Let's not forget, within the next 12 months, we expect OpenAI to turn on ads. That's going to take from both of them, but more from Google because it'll be more search ads.
When we get that announcement, I will open my phone and short Google in every way possible at every duration possible. I will sell call spreads. I will buy put spreads. I will buy inverse Google ETFs. It will be the trade of the century, and my profits will only be limited by how quickly I can get into it. Okay, maybe I'm being a tad hyperbolic, Because Google might have a dead cat bounce when they match OpenAI's announcement and state that they'll also start placing ads into chatbot results. But they're not the leading chatbot right now, so if things continue like this, it won't even matter. Google could be the short of the century, but the short isn't in play until OpenAI is much closer to turning on ads. By the way, have you ever noticed that new things just wind up looking like old things? Like streaming video, for example. When Netflix first came out, there were no ads, and you could binge watch a whole season of a show. Now there are ads, and they seem to release new episodes of popular shows once a week to keep you subscribed. In other words, streaming is increasingly looking just like old cable TV used to look. But that doesn't matter to Netflix, because they managed to bankrupt the entire cable TV business and transfer all legacy media's revenue to their own coffers. OpenAI is going to do the exact same thing to Google. And there's only one thing that might be able to save Google. Yeah, you guessed it. That would be Apple. You see, the main way that Americans interface with AI today is through the ChatGPT app on Apple devices. Whenever you need information, you switch to the ChatGPT app and type or ask a question. And the reason you do that is because Apple doesn't have its own AI, and it won't. Apple hasn't sufficiently invested in building large language models or building big AI data centers. They have some small models, but the idea that frontier AI models will be runnable on phone hardware is still a pipe dream. In order to stop the rising dominance of OpenAI in the tech world, Apple has to somehow integrate AI natively into their iPhone. Since they don't have the juice, they'll have to partner with a big AI company. And there's really only three options: OpenAI, Anthropic, and Google. Obviously, they're not going to partner with xAI. So here's Dan Ives on the Apple-Google partnership.
But this is all the drum roll to what's going to be 2026, the year for AI. When it comes to Apple, especially with what I believe what's going to be Google and Gemini as the partner, everyone's playing for AI. You look at Amazon, look at the hyperscalers, you see what's happening on authentication, and we see on Orbs, I think you also see on CrowdStrike and some of these cybersecurity names. Apple's going to get into the AI party, but it all comes down to Google, once they won that DOJ suit, now it clears the path for what's going to be, I believe, a massive Google Gemini partnership on AI. And that will be ultimately when you look at the next 1 to 2 cycles.
So two things need to happen for your Google shares to stay alive over the coming years. First, Google needs to be ready to integrate ads into Gemini and make that announcement right after OpenAI announces ad integration, or even before, if they want to preempt OpenAI. Second, they must win the Apple contract. Gemini must be default on the iPhone. Android-based phones have a large amount of the smartphone market share globally, and Google already has AI dominance on those phones. So if Google can win the iPhone contract, they can essentially win the entire native phone AI market. If the contract instead goes to Anthropic or OpenAI, then I predict YouTube is on the way to becoming Google's largest business unit as traditional search gradually goes bankrupt. By the way, all of this affects Apple too. We all know that 15% of Apple's operating income comes from making Google the default search engine in Safari. And while many analysts were terrified that the DOJ antitrust suit would end Apple's ability to extract $20 billion in annual payments from Google, they breathed a sigh of relief when it didn't. But the same Apple analysts failed to realize that maybe Google won't be able to continue paying Apple $20 billion a year to promote Google Search if everyone stops using Google Search. And I know what you're thinking. When people stop using Google Search, Google can pay the same $20 billion to Apple, but just for being the default AI provider instead of the default search provider. That would be swell, except that Google pays Apple $20 billion a year because Google Search makes a lot of money. AI, on the other hand, is not yet profitable for Google. When a product is losing you money, offering it at a larger scale doesn't necessarily suddenly make it profitable. It might just lose you even more money. It might sound like I'm also making an argument against Apple, but that's not necessarily the case. I mean, I have argued for almost 2 years now that Apple has lackluster growth compared to AI stocks. On Apple's most recent quarter, they made $102.47 billion instead of the expected $102.26 billion. If it sounds like a small beat, that's because it is. They beat revenue estimates by 0.21%. And if you want to get excited about their 4.5% EPS beat, don't. Because 60% of that earnings beat came from a mysterious practice we call share buybacks. Some analysts are shouting from the rooftops that iPhone 17 sales have been strong, but I still remember the iPhone 16 launch when literally no one upgraded, and I fear that episode could replay in future years. Not to mention, what they're not telling you about the current iPhone launch is that no one wants the iPhone Air, the actual new product that Apple just released. You see, that's the real problem here. Apple used to be the company that was either first to release something groundbreaking or first to make something groundbreaking actually work. Now they're neither. Now, of course, Apple has a monopoly in the US smartphone market. And since their monopoly is in a hardware that we're all addicted to, rather than a software like search that we're all rapidly abandoning, you shouldn't predict Apple's demise just yet. Actually, the only distant competitor to their smartphone is Meta's new display glasses. Those glasses will ultimately be able to do much of what today's iPhones can do, but it's not clear if wearing glasses all the time is more attractive to consumers than carrying a phone all the time. In the end, you need to be aware of all these dynamics if you're a shareholder in Google or Apple. We are not. Actually, we haven't owned Apple or Google in quite a while because when you only have so much money to invest, why not invest it in the companies that are all gas and no brakes? Companies like Western Digital and Seagate, which we told you about on June 17th before they proceeded to rise 157%. Haven't seen that from Apple or Google this year. Yeah, it's been quite the year. This year, we managed to cover most of the best performers right before they skyrocketed. CoreWeave, Nebius, Applied Digital, Broadcom, Western Digital, Seagate. Those are just some of the stocks we've covered this year that are up over 100%. Now, granted, we missed a few performers like First Solar. Did you know that First Solar is up 108% over the last 6 months? I thought the Trump trade was to sell solar and buy gas. But ironically, the Trump trade of China import tariffs actually trumped the other Trump trade and has been helping domestic solar companies. But, we're about to trump everything anyways because as of hours ago, it looks like the Supreme Court might be overturning many of the tariffs. First Solar is one of the few non-AI companies that skyrocketed this year, which makes sense because AI spend accounted for 92% of the growth in GDP for the first half of 2025. In other words, the US economy isn't really growing without AI. Should you be concerned that the US economy isn't growing except for the effects of AI? In 2024, we were acutely focused on the possibility of a recession. And I told you multiple times that 3 big things were predictive: job numbers, especially the monthly labor report, ISM PMIs, especially ISM services, and GDP. So the official labor reports that we haven't gotten for the last 2 months are probably pretty bad. And how do I know that? Well, they actually had the October labor report completely ready to release. And when the shutdown started one day before the release date, they were told not to release it. But somehow the exact same government department has been able to continue work on and release a CPI report that the market has welcomed as good news. Seems a little fishy, huh? But we have gotten labor reports from ADP, the previous of which was the worst since early 2023. But good news, this morning we got a pretty good one. It's about where it should be considering immigration and a lot of other things that are going on. Also, economists are able to piece together unemployment numbers from aggregating state data. And since the government shutdown, new unemployment claims are relatively unchanged nationally. We also got ISM services this morning, and it was pretty good too. So it appears we're not barreling into labor-induced recession. And the job losses that you're hearing about, yeah, some of them have been in tech, but they've been worse for lower-income workers and recent graduates. And if you're not in those groups and you own stocks, things really haven't been too bad for you. You see, the top 20% of households account for 40% of spending. The bottom 20% account for less than 6% of spending. The government gives out $10 billion in food stamps each month, but that $10 billion only accounts for 0.35% of GDP. So who are the people who account for the majority of GDP? The people who are still spending and aren't part of the labor market that can't find jobs right now? I would argue they're the same 62% of Americans who own stocks. So instead of worrying so much about GDP or jobs numbers or ISM reports, I'm throwing all that out the window and I'm focusing on 2 things as early indicators of a recession. The 62% of America keeping the economy afloat are spending more because their stocks have gone up so much that they can feel they afford it. When their stocks go down dramatically, they'll have to stop spending and they'll even sell stocks to save capital, making the market declines even worse. But the initial decline that spooks them will only be caused by one thing, and that's flattening or decreasing capex by hyperscalers. Because keep in mind, this whole market is about AI right now. So when companies like Meta or Google or Amazon start to say on their earnings calls that they will not be spending more on the AI build-out, that's the beginning of the end. You can expect immediate and huge declines in stocks when that happens, because I'm not the only one watching that metric. All the big money is. The second factor that could cause the 62% of Americans who drive the economy to sell their stocks is when they begin to receive notifications that their labor is no longer needed since an AI agent can do it just as well or better than they did. We closely monitor the capabilities of agentic systems and analyze all AI news every single week. So we'll know when true job replacement AI is emerging long before the unemployment rate starts to go up, and we'll let you know right here on this show. Here's the interesting part. Both of those things seem possible in the next 5 years, but both of them seem extremely unlikely in the next 14 months. So that means 2026 is going to be a year when you want to stay invested. Bull markets are meant to be ridden, not timed. The bull market ends when the tech profit expansion ends. The bull market ends when the CapEx expansion ends. But we are not there yet. So for you to stay invested, you must work hard to actively ignore anyone dumb enough to use valuation as a reason to sell winning stocks. I'm talking about those people who think that what goes up must come down and always miss the up since they're so worried about the down. Don't take it from me, though. Take it from the head of hedge fund research at Goldman Sachs, Tony Pasquarello.
There's no doubt the market's top heavy. There's no doubt it's concentrated. We know this, right? 10 companies comprise 25% of global equity market cap. And it's been narrow, right? So here we are, November. You look back since the start of September, equal weight S&P's dead flat. Semis are up 25 or 30%. I'd say two things about this. Number one is, if all someone does is kind of lament the fact that we have a top-heavy market, you've missed an incredible opportunity set for the past 3 at 15 years.
They are out there.
They're out there
because we've heard about it. We've heard about it for the better part of that period of time.
That's right. And the second thing I would say is, and we talked about this last time I was on the show, if you go back to start of 2009, and again, NASDAQ's up 16 of 17 years, and you ask, why did that happen? Only 10% of that is valuation. 90% was earnings growth or dividends. So quite literally, the stocks at the top of the index have earned their place, and I'm just not willing to shoot against the revenue story.
Because the most important point I think you make is the one at the very end of the notes that I have from you to our producers. Does this history book tell us that highly concentrated markets have to end badly, and you say no?
So I think any basic study of breadth, and people throw this term around, it's not obvious to me it's some particularly high quality lead indicator. You can look at long periods of market history. You can remain concentrated for a long period of time. It happened in the 90s, it happened in the 70s, and the history book doesn't tell you this portends a big sell-off. Sometimes it sets up a momentum reversal, some of the kind of rotations we've seen, but it doesn't tell you the market has to tip over necessarily.
When you have a day like we did, as I was discussing with the panel earlier, where you have like the worst breadth ever for an up day, somebody like you looks at that, and what's your conclusion to that?
Well, it is, again, through the prism of an equal weight index, it's obviously unequivocally bad news. I think the key is you just need to keep your eye on the ball, which is US mega cap tech. Then I would take a step back and I would say, okay, if I want to be negative, if I want to take that as a signal to be negative the market, I'm going to shoot against 4 big forces. I'm going to shoot against the Fed, so I'm going to violate rule number 1.
Okay.
I'm going to shoot against an expected cyclical upturn in the economy. We believe that's coming in 2026. I'm going to shoot against all of this CapEx. As we know, that train just picked up more speed last week. And I'm also going to shoot against the flow of funds, which is every day we walk in the office, retail buys the market, and corporates buy the market. So, Scott, you and I have been around a while. It's really hard to pick tops. For my money, again, keep your eye on the ball and stick with the freight train that is US mega cap tech.
In the crypto investing world, they like to use the term top signal to describe an indicator that the market has reached its ultimate peak and is about to decline. So my top signals for this bull market are when Mag 7 companies stop increasing spending on AI, or when at least 2 people amongst your friends and family have lost jobs to AI, or when you find yourself standing in line next to a humanoid robot. Until I see one of those top signals, I'm just considering it the best time in our lives to be invested in the stock market. So if you thought you missed it, you didn't miss anything. It's just getting started. Before closing out, I wanted to make a request to you, the listener. I know what you're thinking. He's going to ask me to like and subscribe. No, not that. Don't care. What I'm requesting of you is that if you've ever made $1 in the stock market, that the next time you're talking to a friend or family member or coworker or really anyone, try to find a way to mention that you don't believe in socialism. Don't worry, I'm not going to get all political on you, but I did feel a responsibility to inform you that when I asked ChatGPT to list the most successful socialist nations, the list was China, Vietnam, Cuba, Laos, and North Korea. If only someday we could be as great as Laos. Look, the reason I made this request of you is because, believe it or not, capitalism is really not enshrined in the Constitution of the US. So the Fifth Amendment does give some protection of private property, but overall, there's not a whole lot there to protect the US from becoming a socialist nation. What's interesting is that Karl Marx, author of the Communist Manifesto, actually believed that socialism was a transitional phase on the path to communism. He believed that nations go through stages, and due to the internal conflict that capitalism creates, they ultimately transition to socialism and then communism. Communism is the end goal of socialism. And in communism, there is no private property and no stock market. I know. China has a stock market. China is more socialist than communist, and they have a relatively successful stock market. But it's just not the same as our stock market. And really, the reason China isn't fully communist is because no nation has ever fully achieved communism. Because communism doesn't work, and neither does socialism. So keeping in mind, there is little constitutional protection to stop our nation from spiraling downward into ideology that doesn't work, please don't be afraid to label yourself publicly as a proud antiso. Thanks for listening to our show. Please give us a rating or review, or on YouTube a like or comment, and we'll be back in the next episode to cover more AI stocks. Oh yeah, and if you're looking for daily AI news updates, on our YouTube channel, we actually have an AI bear or an AI bull discussing some of the biggest stories from the market each day. We have a human employee who puts it together, and he's doing a great job. So please check that out.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. Revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.
So I wanted to record a quick clarification. Yesterday, I released an episode with extremely coincidental timing, because in that episode, I was talking about Google and Apple and speculating quite a bit on what a deal could look like between the two of them related to integrating Google's Gemini AI into Apple devices for Siri. So it just so happens when I recorded that episode at 4 p.m. Eastern Time yesterday, I was not aware that 2 hours previous, there had been a huge article in Bloomberg with a leak about the deal that is underway. So you might find it interesting to listen to the full episode yesterday and judge how close or how far off I was from guessing what the deal would look like compared to what it actually looks like that we have here in Bloomberg. So to me, the biggest surprise is, first of all, that Apple is actually paying Google instead of Google paying Apple. And it looks to me like the reason is not only that Apple won't be allowing Google to integrate any ads into Gemini, they won't even be telling people that this is a Gemini model. So it looks like Google is pretty much providing a product to Apple that Apple will use for Siri, but it's not going to be branded as a Google product. They pretty much made the model for Apple, and Apple's paying for that model, and that's it. Contrast that to the Perplexity Snap deal that we had, where Perplexity is actually paying $400 million to be in Snap. With a deal like that, you can assume that Perplexity will be pushing its brand and maybe even finding a way to integrate its ads into Snap through that deal. So this isn't a full episode, just wanted to mention that I actually did not know about the big deal while I was speculating on what it would look like when I recorded and published the episode